So once we're done um, with the cost of equity calculation using dividend valuation model, our capital asset pricing model, and once we're done with the cost of debt according to which kind of security it is, redeemable, convertible, the next thing is we have to find the cost of capital, or weighted average cost of capital. Remember, what is the weighted average cost of capital? It is the average of both the cost of equity and the cost of debt. Okay, so weighted average cost of capital is the average of your cost of equity and cost of debt. Now, how to calculate the WACC? By the way, to calculate the WACC, we have a formula, and this formula will be provided in your exam formula sheet. Look, this is the formula sheet, and you can see here's the formula which is given to you for the WACC. Okay, uh, what it is basically means, I will try to explain you logically. Uh, Let me show you from here. So how to find the WACC? Same formula. So formula will be provided to you. But let me explain what is the VE here or VD here. Okay, KE we know is the cost of equity here. The KE is your cost of equity, and the KD is your cost of debt. What is VE? VE is the value of equity. Okay, VE basically here stand for VE and VD are the market values of equity and debt, basically. So keep in mind, WACC we always calculate based on the market values. The WACC we always get based on the market. Okay, what it basically means? Okay, let me try to explain logically. Okay, suppose we find the cost of equity already. Our cost of equity is 10%. Let's say we find our cost of equity already, and our cost of equity is 10%. And we find our cost of debt as well. Let's say our cost of debt is, say, 6%. Okay, we find already both of it. Now, what is the market value of equity? We will learn how to find it. Okay, and what's the market value of debt? We will learn how to find it. So, what is this? Let's say the value of equity, that the money that you acquired through equity is 4 million. 4 million. Okay, and the money that you acquired through debt is, let's say, 6 million, or let's say vice versa, 6 million you arrange, or 7 million you arrange through equity. Okay, 7 million you arrange through equity. So the value of equity, better you will say MVE, market, because we always use market values. We prefer to use market values here. So the value of equity is let's say 7 million. Basically, it means we arrange 7 million of finance through equity and 3 million of finance we raise through debt, let's say. So basically what we are trying to do, 7 million over 7 million plus 3 million. So basically what we are trying to do here, 7 million we finance through equity divided by the total finance we raised this year, the total finance we raised in the entity. So basically we are trying to find how much percentage of finance we raise through equity, right? So basically what we are trying to do here, we are trying to find the percentage or proportion of equity, which is how much? 7 million over 7 million plus 3 million. So it's 70%, right? Or 0.7. We will get 70%. Multiply by with your cost of equity that we find already 10%. Plus then, okay, 3 million is your cost value of debt. Then, okay, 7 million plus 3 million, the total. Once again, we are finding what? The proportion of debt. I mean, how much proportion, how much percentage of finance we raise through debt. So it's 30% here, 30% here, and multiply with your cost of debt, which is 6%. So that will give you your weighted average cost of capital. That was the traditional way of calculating the WACC. But now the problem is you are going to solve this question in the Excel sheet. Not in this way. Look, when I was a student, there was no Excel sheet available. We solved everything on paper. So that's the formula we used to calculate the WACC at that time. But now, because you have to use the Excel sheet, so how to solve this question in the Excel sheet? Okay, I will try to explain you by doing this question. Okay, so we will do this question. And so basically what we have to find four things: cost of equity, value of equity, or market value of equity, cost of debt, value of debt. Four things we have to find. If you have two debt, maybe you have preferred debt, you have preference share as well, you have bonds as well, you have bank loan as well. So for all threes, you have to find the cost of debt, cost of preference shares, cost of bank loan, and values of all you have to find. WACC, where do we use? We use the WACC in investment appraisal. We use the WACC to understand our internal rate of return. We use the WACC to get our internal cost of the company. Okay, because we are not going to use cost of equity only. The cost of equity is just the cost we have to pay to the shareholder, and cost of debt is just the cost we pay to the bondholder. So we want to know our average cost, our total average cost. So WACC is the thing that you use in your NPV, in your IRR, in your discounting, not the cost of equity or cost of debt. Keep in mind, right? So we use it everywhere, right? We use it in business valuation as well, because we also discount the future cash flow. So wherever discounting we use WACC. Okay. Okay. So what we have to do, we have two requirement here: calculate the weighted average um, cost of capital using the market values, A requirement, and B requirement using the nominal values. By the way, keep in mind, you are not expecting to calculate this in the exam. Examiner will always want you to calculate using the market values. Even examiner will not show you, examiner will not tell you to calculate using the market value basis. So always preferred method is use the market values of equities and debt. Okay, let me find out the things here. What are the options we have? Okay, Butchco has 1 million loan notes. So first of all, you have loan notes by nominal value, with the nominal value per loan note is $100, quoted on the market price is 50. They have loan notes, 625,000 preference shares as well, okay, and 5 million ordinary shares as well. So they have three different type of securities. They have ordinary shares, they have preference shares, and they have bonds, loan notes. So what we have to do, we have to find six things here. First of all, we need to find the cost of debt, the cost of preference shares, the cost of equity, and the market value of debt, the market value of preference shares, and the market value of equity. So we have to find these six things, then we will be able to find our WACC. Okay, so how we will solve it in Excel? Let's try this in Excel sheet. Can we use Excel sheet in section A only? I don't think so. But yeah, you can scroll to section C, and in Excel sheet you can calculate if you wish to. But there's no Excel sheet available in section A and B. Okay. Okay, let's do this question now. So look, we have three things here. We have three securities here. Security is a common word we use for shares, bonds, preferred stock, for everything we use. Okay, so keep in mind we have three type of securities: loan notes. We have loan notes. We have preference shares, and we have ordinary shares. Okay, preference shares and ordinary shares. So what we have to find, first of all, the first thing I have to find out is their market values. Okay, so I will find out their market values. Okay, sometime they will provide you the market values, sometime he will not provide you the market values, and we have to find out. Look, let me show you here in the question. Let's start with the loan notes. Let's start with the loan notes. So he said, loan notes, what is this? 1 million loan notes. What is this? 1 million. There's a book value of the loan note, right? Their par value is $100 and the market value is $50. Market value is half of the par value. So we need to find the market value of the bond, not the book value of the bond. The value which is given to us is the book value of the bond. Similarly, I will start with shares. He gave us 5 million ordinary shares. He gave us the value of shares, by the way. And they said it's quoted at 25 cents. Nominal value is 20 cents. Quoted mean trading at, currently trading at. Mean market value is 25 cents. So look, for the shares, I can find it very easily. Okay, if I want to find the market value of ordinary shares, I know what is the number of shares, 5 million share, and what is the price of one share, 25 cent. So into 25 cent, right? So what is the market value of ordinary shares? 1.25 million. That is the market value of preference, sorry, ordinary shares. Okay, I can say that. That's the market value of ordinary shares we have. It's clear. Look, by the way, here he gave us the number of shares. He gave us the number of shares and he gave us the market price. Sometime he will not give us the number of shares. Market price definitely he will give you. But he will give you the book value of shares or the share capital. Remember, the share capital. What is share capital? It has a formula. What is share capital? Share capital is equal to what? Formula for share capital is what? The number of shares multiplied by the par value of share. That will go to share capital. Anything above the par value will goes to share premium account, right? So the formula for this is number of shares multiplied by par value or nominal value or face value, whatever, okay, you can find in this way. Look, so what if he don't give you the number of shares, he might give you share capital. I mean, let's say he say like this, number of, okay, share capital is 1 million. Share capital is 1 million and the par value is 50 cent and the market value is $1.5. So tell me how I will find the market value of the bond, market value of the shares. First of all, we have to find the number of shares. Number of shares given? No. So how we will find number of shares? We will take this thing down here. We will find first of all number of shares. Look, if he give us number of shares, then we multiply by the market value straight away. Like in this case, look, he gave us number of shares, he gave us the number of shares, and he gave us the market value per share. So easy. But if he don't, he in exam, he will not give you number of shares. He will tell you the share capital value or the book value of shares, which is what? Number of shares multiplied by par value. So find the number of share first. How? Share capital divided by par value. So you find number of share how much? Okay. How much number of share you will find? 1 million is the share capital value divided by par value 50 cent. 2 million shares multiply by 1.5. So 2 million multiplied by 1.5 is 3 million is the market value of equity. Understand? Okay, Darren? Okay, so this is the way to find the market. If it is not given, I'm telling you. Same thing we apply for the preference shares. And same thing we apply for the loan notes. Okay, for the preference shares, same. Share capital, formula is share capital is equal to number of preference shares multiplied by par value, or share capital, or you can say the word book value of preference shares. Same thing, same idea you will apply for the loan notes. So you can say that book value of loan notes, book value of loan notes is equal to number of loan notes or number of bonds multiplied by par value. Share capital, number of preference shares multiplied by par value. Share capital, number of ordinary shares multiplied by par value. Okay. This is a way to find it out, right? Now, I hope that you understand what I'm trying to explain you. Not difficult, not so much tricky, very easy concept that you need to grab. By the way, in this example, it's pretty much easy, and he gave us the number of shares in the exam, 5 million, okay, number of share, 5 million, and quoted at 25 cents. Now, find out the similar way, let's find out the market value of the loan notes. Look, for loan notes, he gave me what? Book value of loan note, which is 1 million. He gave me the par value of loan note, and he gave me the market value of loan note. So first of all, I need to find how many number of loan notes the company had issued. So it's 1 million. Look, book value of the loan note is 1 million divided by par value. 10,000 loan notes company have issued. How? To find the book, okay, to find the number of loan notes, par value should come on that side. It will be divided with the book value. You will find the number of loan notes. Right? Now, multiply with the market value of one loan note. He said it's 50. So multiply by 50. So 5 million is the market value of the loan note. Same we will do for preference shares. Let's see for preference shares. He already given us the number of shares, which is very easy. He said our preference share is 625,000 and quoted at 40 cents. So very easy. For 625,000, 625,000, sorry, 625,000 and quoted at what price? 40 cents. So 0.4. Okay. So we find out the market values of all of these three things. Okay, we find the market values in dollar, and let's find the total as well. Total is 2 million. So total company, the total funds that company financed through loan notes, through preference share, through ordinary share is 2 million. Now let's find the market value in percentage now. I will find out in now ratio because I need in percentage. Okay, so how I will get it? Very simple. 500,000 divided by 200,000, so 25%. Multiply by 100, of course, you will do multiply with 100. So 25%. Okay. Similarly, you will find for these as well. So 250,000 divided by 2 million, 12.5%. 1250 divided by 2 million, 62. Of course, total must be 100%. Okay, so we find the market value. First of all, we find the market value in dollars, then we find the market value in percentage. Right. Now we will find the costs. By the way, in this question, the costs are already calculated for all of these three. So we simply have to copy paste. Okay, he mentioned it here. The cost of capital is 9%, 12%, and 18% respectively. I mean 9% for the loan notes 9% for the loan notes, okay, 12% for the preference shares, okay, and 18% for the ordinary share. And it's not justifiable as well. You know that ordinary share are very expensive and normally the cost is higher than any other kind of security. Preference shares are basically lesser risky as compared to ordinary shareholder, but more. So their cost is normally less than the ordinary share, but more than the other kind of bonds, and then 9%. Fine. Now find what? Find the weights. Okay. How? Just multiply this with this percentage, all of these three, and sum them up. That is your weighted average cost of capital, 15%. Sorry, 15%. This is how you will calculate the WACC in the exam. Easy. Find the market values, multiply with the costs, find the weights of them, and add all of them. So what is the weighted average cost to the company? 15%. Yeah, you have to pay 18% to the bond to the shareholder, but the ordinary shareholder, its only weight is 62.5%. So we multiply with this percentage. So what is the average cost to the company? Look, whatever company finance, how much company finance? 2 million funds financed by the company. So what is the average cost of the 2 million? 15%. So that's what we are going to use in our NPV, IRR, investment decision, discounting, wherever we are going to use. We know because our average cost is 15%. Is it clear? If you understand, we finish this topic, our weighted average cost of capital. Here. In the exam, the cost will not be given. You have to find the cost as well using CAPM, using cost, using DVM, using method. You have to find cost of equity, you have to find cost of debt, and then only then you can find the WACC. Okay, try this question. So of all, identify the type of securities you have here. Okay, try. I don't want to interfere first of all, because some students are trying. So we have only these two securities here. So what we have to do, find the value of equity, value of debt, and find the cost of equity and cost of debt. That's it. Okay, this we are going to use DVM here. Basically, the price is given, but this is a cum div. We have to find X div. So what's the way? We have to subtract the dividend amount here. Dividend is 9 cent. So what's the X div price? 146 cent, right? 146 cent. This is the X div price. Keep in mind. Our X div price, $1.46 or 146 cent. So first you have to use here your dividend valuation model, right, to find the cost of equity, okay, which is what? That's a formula we will use. But growth we have to calculate using the Gordon growth method. Look, he gave us B and R. So G we will find using the B multiplied by R formula. Okay, multiplied by R formula. And for bonds, we have redeemable bonds. So we will use the IRR formula for that. Right. So let's do this. Look how you will work out this in the exam very quickly so that we can try some questions as well. Okay, so here we have only two securities. We have ordinary shares and we have loan notes, right? Okay. First of all, find the cost. You can find directly here, but you can show working, whatever you like. Okay. Working one, cost of equity. I can find directly here. Formula D0, 9 cent. You can calculate in cents as well or a dollar. Okay, I will use dollar. 0.09 into growth. What's the growth you find? G is equal to B into R. R is 10%, right? Payout ratio is 40%. That means retention is 60%. So 10 into 60%. I think 6% you will get. Very easy. 6% you will get. So into 1.06. So G, okay, D naught into 1 plus G divided by, or you can do like this, okay. 1 plus G divided by PE, sorry, P naught. So X day price is 146 cents. So 1.46, 1.46, okay. And plus G, so 0.06. So 12.53%. It's up to you. You can do step by step. Okay, you will show, okay. It's up to you. Look, you want to say like here D0, okay. Let's say D0, G, right? You want to show like this, is up to you, whatever you like, whatever you try. Okay, P0, put D0 here, 0.09, put growth here, 10%, okay, 10% multiply by 6%. So approximately and divide by 100, of course, we will get 6% here. P0 is 1.46 and then apply the formula. It's up to you. Look, now we will do, okay, once again, D naught into 1 plus growth. So 1 plus this, okay, divided by this, and plus G. Once again, you have to do. So it's up to you. Plus G. Oh my God, I made a mistake. D naught into, yeah, here is the mistake I got. No, it's correct. So D naught into 1 plus G, I didn't put brackets here, divided by P naught plus G. So 12.53%. It's up to you. Okay. Depends on how much time you have, you might try this. So I find my cost, sorry, 12.53% or 12.5%. Okay, that's what I get. And then I will find here, this is the cost of the cost of the equity here. You find the cost of debt. Okay, working to find the cost of debt, I definitely have to use the method that we learn. It's redeemable loan notes. 13% is the par value. Tax is also there. Okay. So redeemable debt. Easy way is to use the IRR. Years. How much life? 5 years. 0, 1, 2, 3, 4, 5. Market value today. Interest multiply by 1 minus t. Don't forget to do 1 minus t. Okay. And last year, don't forget to add redemption value. Okay. Same year because we are going to use Excel way. Market value today of the bond is currently trading at 105. He mentioned it. So 105. Interest 13% of the 100. So 13 into 1 minus t, which is 33% tax rate. So 13 into 1 minus 0.33, or you can put 0.67 directly as well. 8.71, 8.71, 8.71, 8.71, 8.71 plus redemption value, which is how much? Redeem at par 100. So plus 100. And find the IRR now. IRR is equal to KD. Is equal to IRR 7% approximately. Is the cost of debt. Look, after tax we have to use 7.5% approximately. So I will put it here. 7.5%. Okay, I find the cost of equity, I find the cost of debt. Second thing, I have to find the market values of both. See, is it available? It is given to us, or should we have to find in the question? First of all, let's start with the ordinary shares. He gave us 10 million shares. So no share capital given. So simple. We have number of shares. What's the price? 146 cent. Use XDIV always. So 10 million into 1.46. 1.46. 14.6 million. For the bond, did he give us number of bonds? No. He gave us the nominal value or book value of the bond. So divide with the par value, you will get the number of bonds, and multiply with the market value, you will find the market value of the bonds, right? Straight away formula. So he gave us the book value, par value is 100. So 7 million divided by 100 and market value is 105. So 7 million divided with par value. So how many bonds you issue? How many loan notes you issue? 70,000 number of bonds you issue. Multiply the market value. What's the market value? 105. So that is the market value of the redeemable bonds. Find this in percentage. Very easy. So this divided by total 66%, and this divided by total 35%, 33%. Okay, costs are given, values are given, find the weight. 10.8% is your answer. 10.8%. What's the answer here? 10.9. Yeah, same answer we get approximately. So this is how you have to calculate your weighted average cost of capital. Okay, so we finished one thing. How to find the cost of equity, cost of debt, and then the last, the weighted average cost of capital. Look, now you have a question number 26. This is your homework. Look, what is it? I'm going to do a question similar to this from the past exam paper, but this is your homework. Here, what you have, we have a lot of things. We have ordinary shares, we have loan notes, we have preference shares, right? So we have to find cost of equity, we have to find cost of debt for it, we have to find KP for it, and then we have to find the market values of all of these, and then you have to find the WACC. That's your homework. Now, let's do a question from the past exam paper. So, look, these three questions I will try to do in the class that almost cover every topic that comes in the exam. So today, let's do, we have a time, Corfe Co from June 19 exam. Let me find it. Look, so here, let's read this question and you will try it, right? The following information has been taken from the statement of financial position of Corfe Co, a listed company. Okay, let's look at the requirement first. Calculate the after-tax weighted average cost of capital. By the way, whatever calculated WACC is after-tax weighted average cost of capital, right? Because tax, everything is adjusted in it, right? And then 9 marks is for discussion. Okay, so here you see we have what? We have ordinary shares, we have preference shares, we have loan notes, we have bank loan. We have 4 things. Okay, read it and try it. Okay, can I make it a little bit smaller? If it's not readable, let me know, right? Yeah, that's it. Yeah, that's the total data to calculate the WACC. Look, one thing I think I missed to explain, we discussed about variable and fixed rate bond, right? Look, remember, any kind of security, debt, which is variable, then its cost of debt is very equal to the market rate of return. And let's say any market rate of return that you find, let's say, look here, he gave us bank loan here, bank loan. And what he say for the bank loan down, it carry a variable interest rate here. So the variable interest rate mean then the rate as per the market. Look, then whatever the KD you find for the loan note, you apply the same for the bank loan. Keep in mind, the variable rate bond or bank loan is closer to the market value. Okay, first of all, try it, and then we will discuss it together. Okay, so first of all, let's go for the, should I do it? Wait. Do it, huh? Okay. Okay, let's say ordinary shares we have. Look, now he don't give us the number of shares, right? So we need to go with the, look, what is the equity value? Look, this is the share capital value, $15 million. You want to find the number of shares divided with par value. Luckily, par value is 1 simply. So same. If the par value is 50 cents, then divide by 50 cents, then 30 million will be number of shares, right? So number of share is $15 million share capital divided by the par value, which is 1. So by the way, you get 15 million. And then number multiplied by market value, which is 6.1. Is X div? Yes, X. So the market value of share we can find like this. Okay, if I want to find the market value of share, KE. Yes, so you can write here market value of equity. Okay, so number of shares multiplied by market value. Okay, so number of shares 15 million divided by 1 multiplied by 6. I can find directly here 15 million divided by 1 multiplied by 6.1. Okay, that's why I don't need to find it. I can find it directly here. And then the cost of equity, we will use CAPM, which is RF. Yeah, it's 3.5 percentage plus beta (1.25) into RM minus RF. He gave you risk premium, so which is already RM minus RF, 6.8%. %12% is my ordinary share cost. Then preference shares. Yeah, here we have. Look, the nominal value is this 0.75, and the book value 6 million, and market value is 0.64. So 6 million we will divide with the par value to get the number of preference shares, and then we multiply with the market value to find the market value of preference shares. So 6 million into 0.64 divided by 0.75, right? This is what you did. So 15 million divided by par value to find the number of preference shares. 0.75, sorry. 6? No, 6 million is not preference shares. 6 million is the book value of preference shares. It's dollar. How could you say it's number of preference shares? This is the dollar book value of preference shares. See, this is the, here it is, here. This is the book value of preference shares, like this. Par value is given. So you have to find the number of shares. So this should come here and divide. So book value divided by par value will give you the number of shares. So how many number of shares you have? Look here, 2 million or 20 million, how much? Yeah, we find the number of preference shares. Now multiply with the par value, which is 0.64. So multiply with Okay, you should tell me this then. Okay. Sorry, I make you confused then. 1, 2, 3, 4, 5, 6. One more zero I need to remove. Okay. 512000. Then we have 8% loan stock, 8 million book value. Par value, nominal value is 100 and market value is 103.5. So loan notes, 8 million divided by par value 100. That means you have 80,000 loan notes multiplied by market value of 103.5. Multiply by 103.5. In preference shares, 6 zeros. No, sorry, my bad. Yeah, no, it's there. Okay, last thing is bank loan. So look, for bank loan, we cannot find the market value. Market values are our first preference. If it's not given, then we will go with the book value. So 5 million we have to use as a market value. Okay, that's the total worth of the business, the capital structure, the total of it. Okay, and then find in percentage. Okay, this is the cost, which should be there, right? My God. Okay, find the weight in percentage divided by this. Yes, 83.26% we finance through equity, 4.66% we finance through preference shares, 7.53% we finance through loan note, and 4.55. Total must be 100%. So we see total is 100%. Cost of equity we find, cost of preference shares. What is your answer? KP. So the formula is D naught over P naught. Dividend of the current year over P naught. Market value of. Yeah. So 6% is the dividend rate. Par value is 0.75. Don't make a mistake. D naught is the dollar amount. Remember? Dollar amount. So 6% dividend multiplied by, so every year you will pay fixed dividend, and dividend is always based on par value. Whether it comes to the ordinary share or whether it comes to the loan notes, its interest is always, coupon rate is always based on par value. So 0.75 into 6%, that give me dividend. Yeah, I forgot you. Okay, 6%. Okay, 0.75 is the par value, and multiply by 6% and divided by the P naught, which is how much? 0.64. 0.64. 7%. Exactly. 7.03. Okay. Loan note. Yeah, tell me. Look, yes, you give 6% interest, you give 6% dividend to preference shares, but 6% of what? Look, we discussed the preference shares will receive the fixed dividend. Dividend is always based on par value. So how much par value of one dividend, one preference shares? What's the par value? 0.75. So whatever par value, you will get 6% of it as a fixed dividend every year. So your dividend is 6% is not a value. 6% is a dividend rate. Luckily, in bond case, our par value is always 100. Huh. In preference value shares, he can give you any par value. Understood? So that's why in loan notes case, if coupon is 6%, then interest amount is also $6 because the par value is already 100. In preference shares, the par value might be any number. If let's say par value is $1, remember in previous case, the par value was $1 and the dividend rate was 9%. Remember? So I did $1 into 9%, 0.09. So always write somewhere the formula. What is D naught? Look, you put the formula for preference shares, right? In front of it, write D naught is equal to par value multiplied by dividend rate. Don't make a mistake. Similarly, when you write the formula for loan notes, I into 1 minus T over P naught, right? I is equal to, that's why I wrote 2-3 times here. I is equal to interest, is equal to par value multiplied by coupon rate. Okay. Next. Okay, we have to find the loan notes. For that, I have to do working. I haven't done any working here. This is redeemable. 5 years time, 10% premium. Yeah. Okay, market value is 103.5. Coupon rate is 8% into 100, so 8. Tax rate is 20%. So 8 into 0.8, right? Because 1 minus T, 1 minus 0.2, 6.4. Plus redemption value. It will redeem at par 10% premium. So plus 110. Hmm. $7% approximately. Yeah, same rate we use for bank loan. Because it's variable, that's why. So the WACC is 11.2%. That's my WACC. That's my answer for WACC. Yeah, then we will use like 1 minus T. Simple bank loan interest into 1 minus T. Because it's not fixed, it's variable, it varies. So that means we will pay according to the market rate. So the market rate is currently the same we find for the loan notes. So we're going to use the same. So 11.2% is the WACC of this company, weighted average cost of capital of this company. Any question? I thought I will finish this topic and I will finish the next topic as well. But okay, we finished at least one topic. We finished at least one topic. And look, now you can do all of these. Look, I have a list of questions here. Tufa ko, Hilna ko, Tinep ko, BKB ko, all of these questions you can attempt now. Or any other question that you can find for WAC, go and try it. Okay, thank you.